Time to invest in some commodities. All right, this is what I'm going to be doing. Check this out. My man Casey or Carrie, one of those two, but I think it's Casey actually. He sent this to me. I've always liked these asset allocation charts. This is from MFS and JP Morgan. All kinds of firms do this. I think they're fantastic. It goes back 20 years. 20 years of the best and the worst. And what you're going to find is you're going to come down here. You got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different investment categories: cash, bonds, global bonds, diversified portfolio, which I believe is 60-40, large cap value, commodities, large cap growth, international, small and mid, and real estate investments. All right, so what you're going to find here is you're going to find standard deviation. And what I've said a million times this Sunday on this show is standard deviation. Let me tell you what, hold on a second. I went to go get my whiteboard, but let me just explain it. So if you have a rate of return of 5%, with a standard deviation, an average rate of return now of 5%, with a standard deviation of 10. All right, so we need those two numbers. And we use this in terms of Monte Carlo analysis because what we're saying is within 3 standard deviations, your portfolio, given past history, would have a 99.8% probability of coming in between these two positive or negatives. So if we have a 10% standard deviation and a 5% average rate of return, we're going to take 10 times that by 3, and then we're going to add 5 to it, 35%, and then we're going to subtract 5 from it, be 25%. So between 99.8% of all probabilities, you would get no worse than 25% on the down and no better than 35% on the up. That's what standard deviation means. I hope that makes sense. Now, to get that, we have to know the standard deviation, but we also have to have an assumed average rate of return for the future. And this is where I think a lot of advisors get messed up. They have this average rate of return from the past, and they extrapolate that into the future. I don't think you should do that. I think you have to have some kind of market viewpoint on what you think you're going to get in the future. And if you just use your previous historical rates of return, I think you're making a mistake. All right, so let's go down here, and this is why I like the commodities. So basically what we see is in 2001, REITs did best, bonds did second best, cash did third best, global bonds did fourth. You can see it's a diversified portfolio. Again, it's 60-40, and international did the worst. And then you'll see the worst year was in 2002. Commodities were up 25, and then large cap growth was down 27. All right, but what we're going to do, what I like about this is that they actually give us the average from basically the last 20 years. Well, not basically, from the last 20 years. I'm trying to do a video here, buddy. And what you'll see is REITs have done the best at 9.71. All right, so that's been their average rate of return over the last 20. And then we go back to the standard deviation of REITs, and we see it's 20.6. So I'll let you figure out if we have what's the standard deviation. If standard deviation is 20 and the return is, we'll just say 10. So that means we take that 20 standard deviation, we times it by 3. That's 60%. We add 10 and we subtract 10. That means within any 99.8% probability, we'd have no greater than a 50% negative rate of return and no greater than a 70% positive return. That's a lot of volatility, man. A lot of variance in there for sure. That would be kind of concerning. Now the best performing, so I guess REITs number 1 over the last 20. And what I like to do is I like to go back and say, okay, REITs are number 2, REITs are number 4, REITs are number 2, number 1 down here. So you can see REITs have been up there quite a bit. 1, 2, 3, 4, 5, 6. 6 years in the top spot, 6 out of 20. So that's pretty significant, man. So REITs have done the best at the top. Now I imagine we got some not really any bad here. 2020, not good. 2018, not good, but that's not horrible, man. I mean, we're talking down 5, down 4 right here, down 17. Finney's going over there Finney thinks he's a prancing pony. Right here, down 37%, is 2008, 2006. 2007 was down 17, 2008 was down 37. Yeah, and then we see it came back up. But anyway, that's interesting. So 6 of the top 20 were REITs. All right. Now we're going to look at commodities. All right. 1, 2, 3. They had 3 of the top 20, but basically they've been horrible since. Look at this. Commodities, 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 commodities. Look at that. 5 straight years of negative returns. Isn't that crazy? And then we even, so hold on, Finney. We got 5 straight years of negative returns. Then the following year, they're up 11. Then they're up 1. Then they're down 11. Up 7. Up negative 3.125. Look at that, man. So going back to the last 10 years. Yeah, 10 years, commodities have done nothing. Nothing. If you look at the previous 10 years, look at that. They were down here in 2000, up number 1. They were up 23% in 2003, 9% in 2004, number 1 in 2005. I think they got smoked. No, not really smoked, still up. They did well in 2007. They got smoked in 2008. 2009, they were up only 19%, which is fine. But I mean, look at this. Look at this run. Horrible, man. And so over the last 20 years, commodities have averaged negative 0.5%. Cash has done better than the commodities. Look at that. Isn't that crazy? Negative 0.5% over the last 20 years. Nuts. REITs did best. Small caps is second best. Large cap growth the third best. Large cap. So look at the difference. This is why I heavy on large cap value. Now, this is my own thinking. I could absolutely be wrong, but check this out. Large cap value over the last 20 had done significantly less than large cap growth. 6.82 to 8.27. That's significant, man. That's 1.5 points each and every year on average for 20 years, man. Look at that. Diversified portfolio is average 6.65. I mean, that's fine, but just at the end, look at that. Look at the difference. We got the top 3: large cap growth, small cap, and then REITs. And look at that. I just want to see look at it. Large cap growth, large cap growth, large cap growth, large cap growth. So over the last 5 years, large cap growth has been number 1 3 times. That just tells me to get the hell out of there. Now, I'm not saying sell it. I'm just saying this is where I'm way overweighted in large cap value. And I'm going to be buying some REITs too. So let's see some REITs that we could buy. So good chart. Let's come back. Let's go to the Vanguard Real Estate Index. This is the mutual fund because it's been around a long time, more than the ETF. And so today we're up to 1.42%. That's the real estate index. Oh, wait, I want to look at commodities. That's what I want to look at. Hold on a second. Vanguard has changed their gold and precious metals fund to the Global Capital Cycles Fund, which is interesting. And let's just look about, because I think, did I see that the portfolio does run by the good folks at Wellington Management Company? I think so. So let's see, portfolio. Let's look at, one second. So they got 35% materials, 14% financials, industrials. Yeah, that looks like energy, some real estate. It looks like an all kind of go wherever you want to go fund. That's interesting to me. Where's the manager on here, man? Let's go to fun facts and fees then. That dog, Finney, that knucklehead. Let's see. I could have sworn. Oh, Finney's got the zoomies. I thought they were run by. Okay, well, they're run by. That's fine. It's run by Vanguard itself. I could have sworn it was run by Wellington. Maybe I was looking at something else, but this might be something worth looking at. I mean, it's not VGPMX. We'll see what the performance has been. Do they take the track record of the old gold and precious metals fund? I don't know. Yeah, it looks like they do. So look at that. 10 years down 5.56%. Look at that, man. 15 years is down 1.36. So this is definitely a commodity-oriented fund. But see, I don't know, because obviously they changed their structure, obviously, here. I mean, that you can't. If you want a true commodity play, you're going to have to find a different fund than this. And off the top of my head, I don't know any. But this looks like it's still heavy into commodities, but it's not a pure commodity fund like it used to be. It used to be gold and precious metals. And now I think they probably had to change because everyone's like, oh, my goodness, I'm losing money. And that's how investing works, man. You got to hang in there. Let's look at USAGX. Let's see if you can still buy this. USA. Can you still buy the USA Gold and Precious Metals Fund? Because this is what I would do right here. Gold USA Precious Metals and Minerals Fund. And that's what they changed it. All right. So this guy was smoking in the first 10 years of this century. It got smoked over the last 10 years. Yeah, so I'm not telling you what to buy. I'm just saying this fund was the number one performing fund in the first 10 years of this century. Isn't that crazy? Yeah, it's still open. All right, cool. Good, good, good. I don't know who these people are right here. So Victory Capital is running it. It's not run by the same people at USA. So yeah, I just whenever they got a different manager, I steer clear. You want to find a manager who's been running gold and precious metals for a long time, commodity or just commodities as a whole. And I just don't know who these people are, so I wouldn't invest in that. So if you have any ideas, I'd like let's look at commodities ETS. And I think I saw AQR on there. Commodity ETF. I got iShares. Oh, there we go. iShares. Let's try this. Wisdom Tree. Let's try iShares. GSG. Let's take a look at this one right here. Commodity Index Trust. All right, I'm down. Dividend is not. Well, is there anything going on here? It's got volume. Do we have performance? Take a look. Yeah, there we go. All right, sweet. Oh, it's been around for a while. Good, good, good. I like that. So this is probably what I'll be looking at. GSG. Don't follow me, my friends. You do your own thing. And here we are. So we started with $10,000, 10 years ago, and we're at 5,000 something, and that was off. It got smoked down here at the end of 2020, and it's come back nicely. But this is a play. This is a play for sure. Look at this: 1 year up 56%, 3 years are down. So this might be a good trend and momentum play. Generally speaking, once things, well, not once, we don't know. Once a trend steps in, a lot of the money starts pouring into it once there's a trend and momentum. Ned Faber talks about that a lot, and I actually think there's some validity to that. Trend and momentum, which is why the S&P, the index, the cap-weighted index will beat, generally speaking, the equal-weighted index because of trend and momentums for sure. But something to think about, my friends. I'd like to hear your thoughts, and I will see you